What is financial repression? Low interest rates, monetary expansion, government regulations. In the past, Asian governments used the ingredients of financial repression to create a recipe for economic growth. For their Western counterparts, financial repression is now the way to ensure public debt is as cheap to service as possible. How does that work? Imagine buying a big house, but you can't manage the mortgage. Big problem. Now imagine you could set interest and inflation rates while your own income is protected and will rise with prices. With an interest rate of about 0.5% and an inflation rate of 5%, you would just outgrow the debt. Problem solved. That's called financial repression. To make it work, governments are using a number of measures to channel cheap funds to themselves. For example, they require banks to hold so-called high-quality government securities by setting high reserve requirements. Push yields down by placing pressure on central banks for quantitative easing. Try to get modestly elevated rates of inflation to lower interest rates or even create negative interest in real terms. Financial repression works more smoothly than raising taxes or cutting spending, but it's bad news for bondholders and savers whose assets evaporate. Over 10 years, savers and investors can lose 12 to 17% of the value of their bank deposits at today's current inflation and interest rates. Financial repression amounts to a stealth tax. Yet it is possible to avoid this silent destroyer of savings by taking measured risks, such as investing in higher growth emerging markets or reallocating assets. The alternative is that opting for safety in a time of financial repression will be extremely expensive.